The greatest investors came from different countries, lived through different generations, and followed different strategies. Warren Buffett built fortunes buying wonderful businesses. Benjamin Graham searched for undervalued stocks. Charlie Munger focused on quality. Howard Marks warned about cycles and risk. Peter Lynch looked for opportunities hiding in plain sight. John Templeton invested where others were afraid. Ray Dalio built systems around diversification and macroeconomic thinking. Yet if you stripped away every chart, every formula, and every investing style, you'd discover one rule they all quietly agreed on. Never let emotion make your investment decisions. Think about that for a moment. It sounds simple, almost too simple, but history shows this single idea has separated extraordinary investors from everyone else. Because the market has never been just a place where money changes hands. It's a place where human emotions are tested every single day. When prices soar, greed whispers, buy more before it's too late. When markets crash, fear screams, sell everything now. Legendary investors learn to ignore both voices. That's the real secret. Most people think investing is about finding the next big stock. The legends knew it was about mastering themselves. Benjamin Graham once described the market as a business partner named Mr. Market. Some days he offers ridiculously high prices. Other days he's willing to sell great businesses for surprisingly little. The mistake is believing his mood should become yours. Imagine two friends. Both invest the same amount of money. The first checks stock prices every hour. Every news headline changes their mood. They panic during downturns, chase trending stocks during rallies, and constantly jump from one investment to another. The second barely reacts to daily noise. They study businesses, invest with patience, and keep adding money month after month, regardless of headlines. Fast forward 15 years. The first investor has been busy. The second investor has been wealthy. That's because activity often feels productive, but patience is usually more profitable. Warren Buffett has often reminded investors that the stock market transfers money from the impatient to the patient. It isn't because patience is magical. It's because time allows good businesses to grow while emotional decisions quietly destroy returns. Charlie Munger took this even further. He believed the biggest advantage wasn't a higher IQ, it was emotional discipline. Staying rational while everyone else was losing theirs. That's harder than it sounds. Our brains weren't designed for investing. Thousands of years ago, reacting quickly to danger kept us alive. Today, those same instincts convince us that a temporary market decline is a permanent disaster. Psychologists call this loss aversion. Research consistently shows that people feel the pain of losing money much more intensely than the pleasure of making it. That's why so many investors sell after prices fall, locking in losses that may have recovered with time. Then there's herd mentality. When everyone around us is buying, we assume they know something we don't. When everyone is selling, we fear being the only one left. Social media makes this even worse. Every day, someone claims they've doubled their money overnight. What you rarely see are the thousands who quietly lost theirs trying to do the same thing. John Templeton famously believed the best bargains appeared when pessimism was at its highest. That sounds inspiring until you actually have to buy while everyone else is terrified. That's when investing stops being a financial challenge and becomes a psychological one. Howard Marks often says that successful investing isn't about knowing what everyone knows, it's about thinking differently while staying grounded in reality. That means asking simple questions. Has the business actually changed, or have people's emotions changed? Those are two very different things. Peter Lynch encouraged investors to look around their everyday lives instead of chasing exciting stories on television. If a company keeps serving customers, growing steadily, and solving real problems, temporary market fear doesn't necessarily change its long-term value. This is why legendary investors spend far more time controlling themselves than predicting the future. Because no one consistently predicts the market. Not Buffett, not Dalio, not Munger, not anyone. What they can control is preparation, their research, their discipline, their patience. And that's available to every investor, regardless of income. Let's make this practical. Imagine the market drops 20% next month. The headlines call it a disaster. Friends tell you they're selling. Social media is filled with panic. At that moment, ask yourself one question. Am I reacting to facts or to fear? That single question could save you from one of the biggest investment mistakes of your life. Next, remember why you invested in the first place. If your goal is building wealth over decades, today's price movement is only one page in a very long book.
The legends didn't become legends because they avoided difficult years. They became legends because they stayed committed during them. Real wealth usually grows quietly. It doesn't announce itself. It doesn't trend online. It compounds while most people are looking somewhere else. So if every investing legend gathered in one room and you ask them for the single most important rule, they might use different words. Buffett would talk about temperament. Graham would talk about Mr. Market. Munger would talk about rationality. Marx would talk about risk. Templeton would talk about courage. But together, they'd all point toward the same timeless truth. Master your emotions before you try to master the market. Because in the end, your greatest investment advantage isn't finding the perfect stock. It's becoming the kind of investor who keeps making good decisions when everyone else is losing their heads. And if you can do that, you're already thinking like the legends.